Hello guys, glad to have you on board again today. This is Wednesday, usual educational day, so we're going to terminate the series of ranges, third and final one for this one, philosophical explanation of these topics. So the goal in here is still the same. We're not necessarily going to go philosophy just for the pleasure of talking about a topic. There is really something going on behind these third and final podcasts on each and every topic. So first of all, we're going to somehow review what's been said previously, trying to extract the core informations, and more than anything else, by broadening our visions to use those fundamentals and stuff that we came up with, and just to put them into broader perspective, is not just for fun. It's always for a purpose. It's going to help you memorizing this stuff, because pure and simply what happens in trading and the things that we do use, they're not just happening in trading. We have lots of references and resonances as well into real life and into other contexts like nature, world, cosmos, whatever. There are some areas in those things that are totally unrelated to trading at first sight, that will show some resonances. And by the fact that we will try to highlight those resonances will help you memorizing the stuff you learned about trading, for a simple reason, because this is how neurons function some way. The more you stimulate a neuron connection, the stronger it will be, and the longer it will last, and the easier it will be for you to memorize this into your cortex. So the basic structure in here is that by doing this stuff, we're not just talking, we're also helping you understanding and memorizing this much better. So this last podcast, no matter how, I mean, some people just basically said, Phil, you should stop the third part in the philosophical topics because they're pretty much pointless. So they're not. Once again, every time I do something, there is a plan behind it. I don't do random stuff. I do, but not when I voluntarily record a video to do it onto YouTube, to put it onto YouTube. So this is not random. If I do it, it's definitely for a purpose. So anyway, I wanted to give you that explanation because obviously, as some people have been raising some questions, first of all, I needed to answer those questions and explain you the whole process. So yeah, this is not random. We're doing this for a reason. And even if you don't see the benefits immediately, those benefits normally still ripple through time. At least, hopefully, they will. Theoretically, they're supposed to. So anyway, let's start doing this job with this range series. So first of all, we need to sum up the core informations that we've been talking about in the previous two podcasts. So we've been absorbing this context within two different ranges, two different areas. The first one was in a more of a mathematical, statistical vision of technical assessment we can make out of ranges in a pure market application. Then we somehow try to broaden a little bit, go into the psychology of ranges. What are the ways our mind will try to fool you with the usual way of fooling you when it comes to trading, and generally resonating through two big and major biases. The first one is the impatience biases, and the second one being the fear of uncertainty. So we've highlighted how those still the same old biases will implicate some alteration of your risk management into range, and how they can impact your trading, and how you should help putting them down, or at least into controllable areas. So for the technical part, what we've highlighted is that no matter how hard you try, you'll never get to predict a range. We've totally assessed that. This is a chaotic structure, and this is the highest level of chaos into trading. That it is far more complex compared to ranges, compared to trends. So, as the level of unpredictability rises to its maximum, we certainly don't want to understand it all. So, the more you try to understand range, the more you're trying to formalize these things, the less you'll actually get the essential elements of through it. So, embrace chaos fucking theory, because otherwise you're just never going to make it in trading, because they're not just happening in ranges, they're happening everywhere, but this is where they happen the most. So, surrender. If you're trying to understand, there is no other option. So, once you surrender, you will understand one thing, is that out of chaos and unpredictability, there are some resonances, and that's what we try to highlight. In a statistical perspective, in a range, everything is purely chaotic, which means you're never going to be able to know where prices will be 20 to 50 bars from now. Like, this is how it is. The further you go in time, the less the predictability is likely going to be true. And that's exactly the base for every chaotic structure. And still, chaotic structure, we've highlighted that they have some areas of resonances in which, even if the overall structure remains chaotic, some part of it remains statistically advantageous to speculate on. Speculating doesn't mean being right, simply means limiting the options of being wrong, and by simply doing that, we do assess how to profit from ranges and how to profit from chaotic structures. So the goal in here was to use this assessment and try to put it into a purely market-oriented structure and context. So what we figured out is simple sets of rules. So let's remind you what those were. So the first one is that you certainly can't predict timing. Range is based off highest level of uncertainty, so you're pretty much going to be balanced by informations coming into the market at a pretty irrational pace. But what we figured out some way is that out of this unpredictable pace of news impacting the market, there is a very nasty tendency to figure them out in two sets of waves, which means two positive news followed by two negative news. And it's hard to say why or how to explain. So if you really want an answer, I suggest you stop, because there is no rational explanation for it. It's just there is a statistical structure in there and you must exploit it. End of the story. So when you see two sets of waves, you don't know that there's not going to be a third one. You goddamn don't know. Sometimes there will. All you know is that statistically speaking, trying to fight against this second wave is more rational than trying to fighting after the first one. And it's also statistically more successful than trying to reverse the third one. So when you see two clear sets of waves, you know that they are statistically advantageous opportunities to try reversing. Just same thing goes on after two sets of bearish waves. All right? So we don't know, and this information all by itself is simply not enough, because you're not just going to say, all right, two sets of waves, I'm in. That's not how it goes. We needed to add rules on top of that, and like piling up some rules to further risk limit. So that was our first assessment. Out of pure chaos, when you see two sets of waves, I mean, you have favorable conditions, at least more favorable conditions than the pure chaotic system in which you don't have any glimpse of a control. So out of this, we figured out the second thing, which is we need to put a structure, a technical structure, and this is the ones I've been teaching you, in order to catch the third range boundary. This is one of the reasons my indicators have built, and my context are built with an acceleration factor, which means they don't build parallel trend channel. They tend to build with a correlation factor that puts them all together, right? That tends to put convergence context. So there is an acceleration factor into both the support and the resistance contexts. And this is the reason why it helps you to figure out these third range boundary, in which time is also playing its game, even though it's the hardest controllable variable in this setup. So we can't control time, but time is also important. We can't control the structure, but we can figure out two sets of waves is the likeliest resonance in a range, and therefore the best way to get to this is to use time as our trend channels. This is the best representation I've found so far. This is not perfect, nothing is, and like we said, we can use Bollinger Bands as well. All right, these are two options. Either we use volatility derivatives or trend line derivatives to assess those areas of interest in which time is playing its game, but not necessarily being the most impactful. But time is playing its game with Bollinger Band as well as trend line. Time is impacting how those structure reacts. If the volatility remains subdued and time passes on, the Bollinger Bands will contract. All right. If the volatility remains high as time goes on, volatility will remain, standard deviations will remain wide, though the Bollinger Bands will remain either flat or they will even broaden in some cases. And our trend line is the same thing. In my algorithm, I study how prices react, and depending on how price react with time, the reaction will be different. All right, like I'm not drawing straight line. If the prices are significantly more into the lower 50% of the trend channel, and I'm accelerating the factor, the compensation factor. So I'm doing the same thing that Bollinger Bands will do, just in a different manner. So this is how we use resonance, using timely based resonance, either by volatility derivatives or trend channel with acceleration factors, is how you do these things. All right, so timing resonance, but that's it. Just to give a structure and filter out uninteresting prices. Two sets of waves is another resonance, and the final one we figured out was the Fibonacci, purely statistical risk-reward assessment, in which we wait for generally 76%, which we get 4-to-1 risk-reward ratio, which is bringing quite some interesting opportunities. And this is where, statistically speaking, purely in the most easiest and beautiful way of statistics, this is where you get. And this one helps us filtering out time, because the problem is we don't control time, and time is absolutely inefficient with Fibonacci. Fibonacci doesn't give a shit of how long you do this. As long as you don't make new highs or new lows, the Fibonacci stays the same, and so that it helps filtering out some false signals coming from trend channels or Bollinger Bands. So Fibonacci's, Bollinger Bands, or trend channels to assess time-based, partially time-based analysis, and the two sets of wave structure gives us 3 uncorrelated inputs to risk limit in a range. That doesn't necessarily explain anything about range. You're never going to control anything, you're never going to understand anything, and you're never going to be able to predict any fucking thing. But those resonances produce positive risk-reward ratios, which means if you trade 1,000 range following those rules, you'll get more profitable trades than you get losing trades. And that's all we care about. You don't care about 1 range, you don't care about 10 ranges, you care about 1,000, and this is how you get the real statistical return of these things. All right, so that's the technical assessment we've made. I hope you're really familiar with it right now, because that's basically that's the ground basis of my entire strategy when it comes to range, because I teach you to trade range first, so that you easily understand how trading really works, and then you get to trend easier structure. You start with the worst, and then you get at better, because it looks like being the most complicated structure when you talk about range, but it actually isn't. It is complicated for a beginner because you simply want to understand what the fuck goes on. But as you really understand that you need to let go with that stupid ID, you'll understand that you simply need that 3 sets of rules to get to navigate ranges. End of the story. All right? And there are far more rules to be learned when it comes to trend. Trends looks like they're easier to handle, but there actually isn't, because in a purely statistical advantageous type of structure, ranges are way easier to navigate than trends. But people tend to believe the opposite way. So that's the reason why I'm somehow reverse engineering the way you should be learning trading, starting with ranges rather than trends, but trying to navigate range will get you far easier as well in the future to understand trends. So it's more like a process. Anyway, we're getting ourselves lost in here. Let's get back to the essentials. So that was the technical assessment. 3 sets of rules, pretty easy to figure out. All you have to figure out is just to freaking let go of trying to understand, and I know how hard that is. That's where we got into the psychological part of assessing these ranging structures, and like we said, figuring out the resonances you might have with your impatience biases and your fear of uncertainty, natural human biases. So we just figured out the core element into that video was to figure out that time is playing a freakingly important role with your psychological vision, which means the example we took, and which I think is a very good one, is that if we were lucky enough to know how impactful would be the waves in a range, let's assess that this would be our bearish 2 sets of waves, and this will be our bullish 2 sets of waves. With these informations, we would definitely know that the range is going to be bullish. I mean, we're going to finish higher than we started. That's obvious. But even if we had that information, the way we're going to process that information is going to be significantly different, because there is going to be a timely effective bias putting in here. This is your impatience biases. So what we figured out is that if we were putting that set of rules by a big bullish first wave and very long consolidative wave, followed by the second big bullish impulsive wave and terminated by the long bearish one, all right, the amplitude, like top to bottom distance, is exactly the same, that the one that we've used in here, and that range, you're going to say, oh man, this one is freakingly bullish. Now let's do the same job starting at the same timing but using different amplitudes. In here we take quite a lot of time to rise, very limited amount of time to consolidate, and by doing this, all right, we're going to have the same outcome, which means the end is that we terminate as high as well in the same structure, but the way you're going to assess those two ranging structures will be different, simply because your mind will process them differently. You are under biased, because you are impatiently biased. What does that mean? That means that you're going to trade differently. You're going to assess different information, even though you shouldn't. Right? Remember that this isn't following any of your rules. This is going to be timely impacted. So normally in here, all you're going to figure out is that your trend channel is going to come for prices earlier, right? But anyway, anytime it bounces below the trend channels, the context channels is where you're going to be interested to buy. And it can do this multiple times. But in the same process in here, Fibonacci will help you, which means Fibonacci is your best friend to avoid being trapped into this type of extreme in which the market is bullish, right, but takes a freaking long time to consolidate and is going to impact your psychology in manners that you will want to trade earlier and break and bend the rules. You're going to say, all right, we've been consolidating for so long. I see so many substructures in here. The two sets of ways not working in here. We're spending too much time. It's getting noisy. I don't understand. All right. So I'm getting impatient. I'm going to be trading at 50% retracement. Why the fuck would you do that? The rule is to at least go 61% into specific cases in which the range has a bullish structure. And in that perspective might be the case. But that's it. You need to follow a set of rules. And if you don't, you're breaking the rules. You're destroying the statistical advantage. Simple as that. So in here, the Fibonacci might be your game saver to avoid impatiently trading because you think it's been lasting too long and has to change. In ranges, time can really be a freakingly bitch. You don't really control time and never will. All right. So that is the first assessment, that in which your psychology can play tricky games to fool you at some point, and how the sets of rules put it in place should normally, if you respect them entirely, get you safer from this one. The second one was the fear of uncertainty bias, the one that we basically highlighted earlier as well, in which, naturally speaking, something that you don't understand is going to bring a lot of stress. Stress means that it will amplify emotions, which means you're going to feel euphoric, you're going to feel panic, you're going to feel whatever, in which you shouldn't absolutely, because you don't nearly give a shit. Remember that ranges can be freakingly complex, as there is going to be breaking structures in ranges. This is like typical context of ranges. We're going to try breaking because we're going to try putting stable structures, trending structures, and we're going to fail. And as we fail, we're going to break a lot, but never going to sustain the trending system. That's the problem. Reintegrate the range, go in the opposite direction. So it's a sustained failure, actually. The ranges, as long as we stay in the range, we will just fail and fail and fail until we actually succeed at some point. All right? So, like we said, the third range boundary is the statistical advantage in which you can trade range safely. That doesn't mean it will reverse. It says that if you put a large enough stop loss, statistically speaking, you'll be fine, and at least you will navigate through potential losses. Some losses will show up anyway. That's how it is. You just can't predict. But yeah, using those things, time will impact, and also your psychology, in which you must absolutely not be impacted by the news flow. You can't control information, you can't control when they are released, and there's nothing you can do about it. So just don't care about information in a range, because if you do, all it's going to do is change the vision of your thing. Let's imagine a purely stupid example in which you just bought that third range boundary and a bad news shows up. You're going to say, oh man, that's a bad news. I shouldn't have bought. Maybe I should exit my trade. Why the fuck would you do that? You just bought your statistical range and chaotic structure advantage. So you just took a trade out of what could likely be 1,000 trades, and if you just do it the same way 1,000 times, you'll likely be profitable. So what the fuck would you care about that specific news showing up when you just bought? It might be impacting, though it might lead you to bad decision making, in which you're not going to respect the rules. You put it a stop loss. The stop loss is supposed to absorb that news, and if it doesn't, then you just took a loss. End of story. Move to the next range, and just move on. And some people won't do that. They will let themselves be impacted, and they will say, all right, nah, the news is really too bad. I really think my stop loss is going to be taken down, so I'd rather like to take it right now. What the hell? I mean, this is not how we trade. We don't trade because of what you think of the news. We trade because you have a structure and you get them follow it. So don't let yourself being impacted by news. Always goes in the opposite direction as well. Like you just bought, you've got a good news and you say, oh man, this is going to trend hard and this is going to make me my money. It is going to bring money quite fast as the news flow is getting positive, and you're going to have a positive news flows and prices will just keep on following, which means you're gonna be in here and you're gonna say, oh man, we just tested 50% Fibonacci's. I know I should wait for 61, but god damn it, there is a freakingly good news. And you're gonna enter right in here and you're gonna say, the news is so good that the price will go there without me, so I need to get in. What the fuck is going on? You're supposed to wait 61%. So even if prices are there, you wait for 61, and most of the time you'll get a good news and price will still go to the 61% or 76. Though this is why you don't let yourself being influenced by news flows in ranges, because news flows will lead you to bad decision-making processes in any way. Even if the news is on your side or against your side, both ways it can only be negatively impacting your trading. So don't give a shit. I know it's hard to fight uncertainty and to literally embrace it, but that's how it has to be in ranges. All right, so now that we're 20 minutes into making a summation of the core informations you really need to process with the previous podcasts, now we're going to try broadening our visions in here, creating connections into different sectors of different way of thinking, different broader visions like human behaviors, planet behaviors, eventually cosmology behaviors and stuff like that. We're going to try broadening our visions to try creating connections, like using what we just learned in here in a purely trading context perspective and trying to use the same way of thinking into different prospects. So you create connections, you solidify them, and you will help memorizing the information. So let's try to do it. If we try to broaden our vision just a bit, I generally tend to do it in a circular manner in which we're just going to broaden our cycle into getting into human-like behavior, trying to find resonances about what we just learned and how this could be applied to some human behaviors. Then we tend to get into planetary scale, like natural phenomenons and stuff like that. And finally, if we want to get the broadest ever vision, we're going to try going to cosmological scales and stuff like that. So in here, I would tend to say that if we just had to broaden to a human vision in here, the easiest way to connect would be to just use life cycles. If we were considering humans, the human life, I mean, going from the moment you're just born to the moment you'll die, there was going to be cycle. I mean, if you study these things, we're all unique. We're all unique human beings in our way of thinking, the way of looking or whatever. No one just looks the same and no one just thinks the same. We're all unique, but there are some significant resonances through human beings, I mean, through human behaviors, especially because that's the core basics of psychological studies, is that even if we're all unique, and therefore we could be as chaotic as could be, unpredictable and whatever the fuck that is, we tend to all behave the same way. There are patterns in chaos. So this is likely just resonating already. Like the way you live is exactly the way structures happen in trading. They're unpredictable, but there are some patterns. So let's try to use this ranging context and try to put it in a human lifetime behavior perspective. What would it look like? The ranging structure, the chaos. Remember what we just said. Range is pure chaos. Range is hesitation. Range is when you're both balanced by good news and bad news in the same time. You're not trending, all right? So let's consider human being and say that range is a non-trending context. So now if you were figuring what the trending context will be for life, for a human lifetime, life cycle, I would tend to say that considering how you process information and how the context, which means what surrounds you, will impact you. Let's just make a really stupid assessment in here and following the trend-based system we know on trading, which is generally we build out of a range, we accumulate, all right, and then we start building a positive momentum, and then we get to trend, and then we get our pullback, and we get the final excess. That's the typical structures we're using into trading, but life isn't that different. It's just exactly, it's not that beautifully assessed, but life is like something getting close to that pattern anyway, in which you just get yourself born, you progress pretty fucking fast, you're learning shit tons of things. That's incredible how a baby can learn so fast. it's not that fast in the beginning. It's really noisy in the first place, and they create, they destroy, they test, they fail, they test again, and they succeed, and they fail, and they succeed, and they fail. It's really incredible. But you're building a mindset out of this thing. This is where you create the basic structure of who you're going to be. Like the first assessment in the first range is the building blocks of your future you are really done by these structures. And then comes like we'll call teenage, in which you just fuck it all up. You really want to destroy everything to just like build yourself a new personality or whatever the fuck that is. As in reality, most of what you're going to be is already been put into rocky, solid structures. You're not necessarily going to change yourself, but you're going to try hard. I mean, that's what we do as when we're teenagers. And this is where, of course, traumas and experience can significantly change who you could have been, because obviously this rock-solid structure is not indestructible anyway. And if you're really traumatized, then you're going to become a slightly different person, obviously. So every step of life is complex and necessarily can't be predicted because you're mostly impacted by what's going to come to you. Like when we said, let's imagine the worst case scenario, you're a teenager, you just got hit by a car. Who the fuck would have predicted that the car would just hit you? But this trauma will literally change how your life will project in the future. So I would tend to say that if we consider teenage in a ranging perspective, that would be the most appropriate structure, in which you're pretty much balanced by good things and bad things happening. You're discovering love, and therefore you're discovering being heartbroken. You're going to discover things, positive things and horrible things, and positive and horrible. And this is really like excitement and despair in the same time. It's really high level of amplitude emotions. That's definitely how range will be. Like if you forecast the emotional amplitude, then it would likely have a ranging structure compared to what we do study into trading. That would be this: irrational, erratic, information news flow coming at erratic pace and unpredictable structure. Like you don't know what the fuck is going to come to you next. You just had a bad news. And what we tend to believe in here is that, I would tend to say I'm pretty biased in here because, all right, that's things have been, I mean, my life is really turning a lot around and circling around trading, so I tend to make some connections that might not necessarily be entirely true, but I tend to believe that we could use part of our structures, of our trading structures into life, in which I don't know for sure, but I would tend to say, let's try it out. Let's study our teenagers and figure out if they do have two sets of waves, for example. Like, I can't tell for sure, but I personally, in my own life, since I'm caring about this, when I have these ranging structures, because this is not just about teenage, just remember that a trend is not a straight line, it's a line in which there are some sub-wave consolidations and stuff like that, all right? It's just the overall system is trending. When I tend to range on my personal feelings and stuff like that, it's stunning, but I tend to feel like just like in trading, the same rules tend to apply. That's freaking, though people would just say I'm crazy, and I would totally understand them, but because I probably are in that perspective, and I think this is really a trading bias in which your working behaviors tend to impact the way you live. But that's the thing it is, all right? I tend to see some resonances as well into that two sets of waves. Generally, bad news tends to come with couples, and good news as well. And this is exactly how it is. And this is only happening when you are in a range, in a moment in which you're vulnerable to external element, in which you feel like you lost control, which is exactly what happens in trend. The market doesn't know where to go, so it feels like it's going to take whatever comes to it. Like it's going to be context orientated. Whatever the fuck shows up, good news, bad news, we're going to price that in, and we're going to stay in the range as long as there is no real consensus emerging from it. I would tend to say life is exactly the same. When you're doubting, when you are into an uncertain area, you're going to wait for things to happen. You're going to take in the bad stuff, and you're going to try to extend the good stuff, but they tend to behave in two sets of waves. That's really odd. And like I said, if you have a really, really, really good thing, all right, happening really fast, you're going to feel that momentum, you're going to feel strong, and if then afterwards you get a long, painful consolidation, you're going to feel depressed, even though in in actual reality, you're still far higher than you were. Time is also impacting in life. That's exactly the same. We're impatient, and we're and we fear of uncertainty. So what happens in trading is also happening into your life. So I would tend to say, call it that way, but it would be like going from your 20 to 35 or something like that, or 40 years old, in which we would be trending because you got health, little health problem, at least that's the best I can hope for you. Normally you're in a good health condition, you're starting to make money, so you have less and less things slowing you down into your personal progress. So you're progressing easily because there are far less structures to slow you down, right? Like money is not necessarily going to be a problem when you get yourself through life. You're starting to get your position into the economy, and you start to feel like you're useful to the economy or whatever. I mean, if you don't, there's no big deal. But that's how it is. Normally, you're starting to put yourself into a safer place, so your fear of uncertainty is just dampened because you don't control the future, but you feel like you have at least a little bit of control, and that feeling of control is pretty comforting. So this is why you like, and we call that the trending period of life, in which you improve your lifestyle, you improve your living conditions, you progress, you learn shit tons of stuff. That's pretty great, and that's it. And then comes what we call the 40 to 50 years era, in which you basically have been working the same job for quite some time, starting to get boring. It's not exciting as it used to be, and moreover your brain is starting to be a little bit exhausted. It's not working as well as it is. Just like your muscles, you're starting to have a little bit of physical problems like gray hairs, whatever that is. I mean, time is playing its game, and you know that what happens previously, I just lost this momentum because life isn't endless and life is a cycle, and in that cycle there is a moment in which your progress that you made in the previous year is starting to slow down, is starting to diverge, and this losing momentum is going to be felt like a depressive conditions. That's what most people experience in their 40s or 50s. I mean, the midlife crisis, let's call it that way. That's exactly something that many human beings are feeling, statistically speaking. No one's feeling it exactly at 40 years old or whatever. There's a period of time in which it resonates, just like our ranging structure and our trending structure. So if life was a trend, the midlife crisis would exactly be that, the pullback. The pullback is a ranging context, all right, in which you're balanced by good and bad informations. You might eventually lose your job, and that might rise a significant level of uncertainty for you, though a lot of stress, whatever, but still some good news happened. Like you just met someone, a new girl, you pretty much like her, that's great. You're going to feel that happy new good news, but she's going to break your heart, whatever. You're balanced by contextualized information, unpredictable stuff, whatever. This is a ranging structure, so try to use that and try to rationalize the way you're living yourself through those periods and try to put it into market perspectives. And just by doing this, you're going to create some easy and solid connections into your brains, into just try to assess this thing. You're not controlling your life, so why the hell would you control markets? This is exactly the same. So get to fucking surrender. Try to work your psychological biases. And in a technical structure, I mean, you can use that. I personally use that, and I like that. That's real funny because anyway, that doesn't help me predicting the future in any way. I don't know shit about what's going to come to me next. But I tend to use that two sets of waves theory anyway. So it's like when I had two bad news, I don't know why, but I have a positive feeling afterwards coming out of it. So I just got hit by a bad news, but I'm saying, all right, that's the second one. Likely the next one is going to be a good one. So that's one way of doing things. Just like after being two positive news in a range, I tend to say, all right, don't get overexcited, man. The next one might be just hitting you hard. So that's just the way I do try to navigate my own personal lifetime ranges, just like I would navigate ranges into trading. And I tend to say that so far, it's not necessarily, I don't have enough feedback to compare to. Like I just do that with my own life, so I can't just say it's working for me, so it's going to work for everyone. But I would tend to say that I'm just like I optimize my trade, I try to optimize some of my lifetime decisions, because obviously, I don't know. There are multiple ranges in the life. But, I mean, I'm trying to follow that two sets of way structures, just like I'm trying to clearly assess and to balance information, not to be too impacted by the way they could be. Like, I'm not trying to make too emotional. When I know that my impatience biases might work because I want something to happen, it's just lasting too long. Like, when you feel depressed, the only thing you can do is wait, I mean, let's be honest, time is of the essence, and you certainly can't predict the moment in which things will do better. I've been depressed the latest couple of months, not the couple of, I mean, the end of 2019 has been a freaking pain in the ass, and you all figured it out. And did I really let myself go at some point? No, I was just waiting for some positive stuff to show up. I was totally unable to do because it was just shit and shit happening each and every day. And I was basically waiting for the good stuff to come. And it did. It's just at some point you can do nothing but to wait. You need to profit from the good stuff, but at some point when you just have shit hitting the fan, then you just need to brace yourself and wait for the good stuff to come. That's exactly what I decided to do, and that's exactly what I do in trading, and I did the same thing in life. So try to make connections with your life and try to put that in perspective, and you'll see that it's significantly going to help you to process those informations you just learned and to make them more of automatisms in the perspective in which you're naturally going to be doing this afterwards because you do it in your life and you're going to naturally do it into trading, and that's the best I could hope for you. To have those solidified knowledge that basically really become automatisms in which you're going to, in which manner you're going to do these things without even noticing. It's going to become natural to do it. All right? So that's one way of learning trading and learning those rules and how to navigate the ranges and stuff like that by using real-time experiences, real-life experiences as a reference point, and trying to apply the same rules in life will help you solidify your knowledge, and use and effectiveness into trading as well. Then we're going to start broadening our visions, getting out of our pure humanly centered visions, like we do tend to feel humans are so great, so important, whatever. Right? Life is way more complex than just humans. So let's just try to stop thinking about just us humans as being the center of everything, and let's put it into a natural perspective. Let's try and define a chaotic structure in our natural planetary scale type of stuff. So the best example I could use in here is the magnetic pole, in which I think that's a pretty good example. That's the one I use for the French guys anyway, so I'm going to keep with this one, keep on going with this one. So let's make that assessment in which I'm going to take a planet, right? Our planet, let's make it simple, all right? So this is our planet, all right? Big circle. What we're going to be doing in here is that we're going to position the pole, which will be the center in here. Let's assume that we're looking at the Earth on top of it, so let's say that's the North Pole. Though what you see in here is the edges of Earth, which is the equator. And basically, as we do have a look at in here, what we're going to study today is the position of the magnetic pole. So the magnetic pole is oscillating basically, and we can consider that there is a comfort area in which it evolves, and it is certainly not this way, right? This is what people will think it is. The magnetic pole is somehow oscillating more of an ellipsis type of based structure in which, just like for a range, we don't know shit about where it's going to go because it's going to be pretty erratic. All we know is that actually the North Pole is very rarely at the North Pole, at the very North Pole, geographically speaking. Most of the time this is an unresonant area, which means you might think this is where the North Pole should be. This is where it is the least. In this structure, there are some resonances, like there are some dots and spots into which we tend to be more than less. So this is just exactly the way it is for us. There is a structure into chaos, which means we don't know where the magnetic pole is going to be millions of years from now because the structure is chaotic. Because actually the North Pole isn't moving like that. It's not having a perfect ellipsis movement. It doesn't. It tends to have elliptical structure, but how these ellipses are moving is significantly unpredictable, because basically the way it moves is more like something like that. Let me just delete that first. All right, let's just start over again. So this would be our magnetic pole, all right, the typical geographic pole. This is our area of evolution, all right. And then, as we get in here, we're going to move like that, all right? Like I said, it's going to be random. We know that it has elliptical behaviors, all right? Though we know that we rarely get to pass into this area, we rather like to oscillate about it, all right? we tend to do something like that, but generally, and sometimes, the North Pole is moving in this area. It's having circular movements, but it is and remains unpredictable, which means there are some areas in which it's tend to pass more, there are some areas in which it tend to pass less, all right? And it's basically doing something like that, oscillating and oscillating. And all we can tell is that just like if we were doing these things, remember what we've done with our statistical assessment of a range. Remember the structure, it's going to be like that, that. That's the assessment we've made in the technical podcast. So let's try to do the same thing with these things. This is our area of interest. So this is when we get to the extreme areas of this comfort zone is where we get to extreme standard deviation. It's the same thing. Most of the time we tend to evolve into a two-dimension, it's called a, oh damn it, I forgot the word. There's a word for it. It's a dual distribution type of system in here. I don't know the exact word. There's an exact word for it, but I'm sorry, I just can't remember. Those podcasts are not prepared. I mean, I'm really coming up with those things without preparation, so don't mind me if some of the processes in here are not exactly true. But anyway, so it would be a double distribution in here, dual distribution. We would have the same thing in which, like we said, our area in here in which we know that the actual North Pole is generally less often into the actual North Pole area than it can be elsewhere. So that will be our dampening area in here. So the distribution isn't clearly exactly the same in here. The structure is way more complex, but this is what we could be. All right. So where would you speculate on the North Pole position and have the most potential rate of success? When you're here, you will say, when we're there, we're likely going to move the fuck away from here. It's hard to say in which direction, but we're going to move away from here. So there is a good point in which you have statistical advantage. It's not the best one to profit from, but it is one. The other thing is that this is when you get to extreme levels in here or extreme levels in there. This is where you get standard deviations. The way, and when you get to extreme levels, you're going to figure out that there are likelier odds for this magnetic pole to return to the mean. That's exactly what it would be. So you never know where the fuck this thing will go, but you know that when you're at extreme deviations, you're likely going to return to the mean. And that's exactly what we observe in the actual real magnetic pole movement. So what we just learned and used in trading is also used into predicting magnetic pole behaviors. We never know for sure where it's going to be because the behavior remains erratic and unpredictable, but we can make some predictions at some specific points in which those predictions tend to be way more true than false. These are areas in which we can find risk management. Simple as that. That's the same thing. And there is one thing that is even funnier with that, is that you know that magnetic poles can reverse. It has been happening multiple times in history, and some people are trying to find the beautiful equation in which we can predict the next pole reversion, because basically this is really important, because in terms of environmental changes, reversing the poles is a freakingly impactful, not to say deadly, context for human beings. So obviously what could kill us is obviously freaking us out. So people are trying to predict when and how these things can reverse. So we know there is somehow a patterns in terms of timing, but this pattern is pretty erratic as well, which means we can't predict. We just can give a time frame in which there are likelihood for these things to happen regarding what happened previously, when we basically has been putting out some shitty tons of ice from the poles to figure out that the magnetic orientations of metallic structures in there has been oriented into different manner, meaning that what we call our North Pole has sometimes in history been a North Pole and a South Pole and a North Pole and a South Pole and oscillating between the two, with somehow of a pattern emerging, but there are just not enough pole reversions to actually say that yes, the next one is likely going to happen in that type of years. But actually the predictive algorithms we build are not based on oscillations of previous pole reversions, but they're based on the fact that we can study the pole movement. So now they can actually say the next reversal is going to happen in that specific period of time, which is pretty wide. Obviously, we're counting millions of years in here, all right? But not really by using how regular the previous reversions have been, but most likely trying to figure out how wide this system is, because this system is unpredictable as well. So the comfort area we've been building in here is stretching and contracting and stretching and contracting. And what we figured out, well, at least what they figured out, is that there is an area historically speaking, in which the statistical odds for reversing poles is freakingly high. So what they assess nowadays is how stretched is the comfort area of our pole and how likely it is to reach out this potential reversal area, in which if we get in here, there are statistical possibilities, and I'm not saying that this happens, I'm just saying statistical possibilities for the North Pole to, instead of returning to normal state, to just bang, to just flow and reverse to the opposite pole. So this is goes to magnetic lines and magnetic flux and stuff like that. So there are some scientific data explaining this, but there is an area in which the North Pole or the South Pole, it goes both, and both tend to behave in a symmetrical manner. So when one of the poles is getting into this danger area, we know that there are statistical ways of calculating odds for reversal. And by the way we study how these things works and how close it can get to these areas, this is how we assess the likelihood of a potential reversal coming right after. That's how we do. That's how we do things. So it's studying the current state of our comfort zone and the current momentum of how the magnetic poles are evolving. We're studying momentum, this is exactly the way we do study prices. We study momentum, we study waves, we study oscillation, we study amplitudes. So you start to see a lot of similitudes in here. And this is one way you can understand that what we do in trading is not just an isolated stuff. It happens into many, many cases. And just like in here, trying to give prediction of likelihood of pole reversions. And this is certainly not saying, because it's been happening 2 times over, let's say, 10 billion years, it's been happening 4 times, so the likelihood is to have 250 million years type of reversals. It's just freakingly stupid. That's definitely not how these guys have been doing these equations. All right? So, oh, damn it. Sorry about that. Cell phone just fell off. Anyway, so that's it for this example. Let's just terminate with another example, trying to broaden even more our visions. You know that humans have been trying to understand cosmological standards and to see how freakingly far we could do in the future. And we actually figured out that the further we can go into assessing our cosmological background, which is looking as far as we can with a telescope, we tend to have a cosmological background. But what we would have expected normally is to have a homogeneous thing, and we actually didn't. So the fact is that we tried to understand that something chaotic in here was happening. So we were supposed to have something flat and linear, and instead we had something totally unlinear and following purely chaotic structure, but tended to have some structures. This is how we emerged our newer let's say the latest decade theory about the dark matter, all right, and all those things. So you can study those things. They're just pretty much the same thing in here. The way we studied what what dark matter is by assessing its chaotic structure had some structure. We took something that is chaotic and we just figured out that there was some type of a structure in here, and we figured out that this is what has been impacting the way our cosmological background isn't uniform, but is instead looking like a chaotic structure. So this is one of the many examples. And if we were going out of this, leaving like the big, massive scales of the cosmological background, basically the highest and the deepest scale we could ever have a look at, let's take a look at the tiniest possible thing. Like, I'm going to say that nasty word, but I mean, don't be afraid. Quantum mechanics. So the way we actually figured out and made some significant progress over the latest decade on quantum mechanics is for the same thing. We figured out that some of the things we were expecting to be true weren't working the way they should into tinier scales, because that's exactly what life is about. When we try to figure out something, we might just figure out and break one wall to just hit another one right after. So when we think we figured out something, we're just gonna crawl ourselves to another wall afterwards that we're going to try to break and get to the next one, and so on. So on a big scale, the cosmological background has been figuring out that it wasn't reacting the way we were expecting it to, so we discovered something. We discovered dark matter. Now, as we go in here, we're just going to figure out the same opposite thing. As we gone to tiny and tinier scales, as we broke molecules, we discovered what was composing those molecules. And as we broke those components, we discovered some things was composing these things as well. And then at some point we got to some tinier scales that our laws of physics wasn't simply working out. We needed new laws. And this is where quantum mechanics laws are just showing up. And in quantum mechanics, what we use is the same thing. We used chaos theory predictability to actually process our things. In order to get the rules, we started to study the chaotic structure and figured out that instead of trying to figure out things, we needed to have a broader vision. And that is, I would tend to say, the latest decade best improvements, whether into larger possible scales to the tiniest possible one. We're coming across chaotic structure in both cases, and the way we deal with those chaotic structures is exactly the way we do deal with market structures chaos. That's exactly the same thing. You don't try to have a broad vision. You're not trying to understand the market because you never will. It's just another world that's going to get in front of you afterwards. Though it's endless thing. We never figure out, and you'll never will. The thing is that anyway, the only thing we can use is a structure in this chaos, and that's exactly how they emerge, the laws of quantum mechanics. Just like I would tend to say, I'm not teaching you the laws of trading and the laws of how market behaviors, how market behaves. What I'm teaching you is a set of rules that explain money management, which is the structure which is the thing that structures market behaviors. That doesn't predict the market, and you'll never know where prices will go, but there is a structure to this fucking thing, and that is risk management. So I told you the risk management into ranges. I'll teach you as well into trends. That's the theory we're going to start by next week, and stuff like that. So I don't explain, and never will. I just give you a set of rules that explain part of what happens. This part of what happens suddenly doesn't say, like, let's just take the basics of quantum mechanics physics right now. Like, it is like, if you're trying to figure out the position of an electron, basically in the past we were saying, all right, the electron is oscillating to its core, whatever. So let's say a neutron, it's got its electron, fuck it. All right, so the thing is that right now, what we're trying to figure out is that, let's fuck that, all right? Let's not even try to figure out where the electron is. What we tend to figure out is there are resonances in the electrons' things. This is what we call layers, in which electrons can be positioned, and they will likely oscillate at that distance from the core. And the thing is that by doing this thing, we're just thinking like we would do in trading. We put it a rule. We don't try to figure out what the fucking electron is. We're just trying to figure out at which layer it is and what it's going to be doing. All right? And we just figured out that these layers was what defines afterwards what atom will have. All right? So at least it's part of the things that will explain what atom will have out of the same components, and that electronic layers may have a significant impact on quantifying what type of atom will have. So anyway, this is not just about it, all right? This is also some other things that when we try to think of electron not just as particles, but more like as radiations, we start to get into the field of quantum theory and quantum fields and stuff like that. So I'm not getting down this road because it's real complicated stuff, and I would require some stuff in my screen to explain and make it more visible for you to understand. So if you like these topics, feel free to dig the internet. There's plenty of informations available out there, not necessarily just for purely scientific minds and stuff like that. There's some lots of video of making these things available for everyone, easier to understand, still getting into pretty complex stuff. So if you're really interested by those things, I can't stress that enough. Just get to feed your brain. As you do learn new stuff, you'll make connections. As you make connections, you get a better memorizing structures of those things and whatever. If you make connections, you're going to be smarter tomorrow. That's simple as that. Make connections. So if you're interested by these things, go dig, and that's how you'll get better. So anyway, let's stick to the basics. If we start to think as electron, as resonance, all right? Like, we don't say the electron is here because we can't know shit about if it actually is here, as it's moving too fast, and anyway, we can't really assess that for some other reasons that I'm not going to explain. But we figured out that something wasn't happening the way we expect, because when we have a look at those things as those electrons, they tend to behave like waves and they don't behave like particles. So when we don't have a look at them, they behave like particles. When we look at them, they look like waves. So something's going wrong, and by putting out this irrational behavior into reality, this is how we came up with quantum laws of physics right now. So it's by figuring out that something wasn't working out the way we expected it to be, that we were wrong with some things, and we learned how to be right until we get wrong with something else. But that's how it is. As we figured out electrons as being waves instead of particles, we started to figure out resonating, and then we started to figure out lots of things like quantum levitation right now is just a derivative of these things, is that we discovered laws, we applied those laws and figured out that the reality was actually working out this way. So we somehow studied chaos, found some structures in chaos, built laws out of here, and figured out those laws were working in the real life. And that's how we discovered things. So I'm not saying that we can use this process into trading, because there's nothing to discover in trading. Trading is an endless evolving structure, in which, as long as we are dealing with the market will always evolve, which means when you start to understand whatever it is, the structure of market itself would change. So there's nothing to understand. It's like it's even more pointless than trying to figure out quantum mechanics, because quantum mechanics is going to bring you something, and you're going to be able to do something with that. In trading, what we do is that we try to give a structure to this thing, not to understand it, not to control, but just to try making a little bit of money. And if the structure changed, we'll eventually have to adjust. But so far, all I figured out is that this is not the approach to do with trading. If you change the way you see trading, you're basically losing it all. So it's more like consistency in trading, because the evolving and the endless evolving structure, the unending evolving structure in here, is basically going to lead you crazy if you try to adjust in real time and every time. So it's more like the only way to get peace of mind and consistency in trading is not changing stuff, is adapting to conditions, like being context related. You don't blindly buy and sell because of stupid conditions. You need to have complex set of rules to adapt, but these sets of rules must not change. So I haven't been decrypting trading, just like some people might have called decryptions of quantum mechanics, but it's the same way of processing. What I would tend to say is that the way I built my rules is like the ways those guys have been using to put out those quantum rules. And we can see that those rules work in the real life, just like I tell you, these things works as well in trading. It's hard to understand why and how we got there, but this is how it is. So I would tend to say these are many ways that we can use how chaotic structure can be very, very profitable in any way, even though they will forever remain chaotic. But I want you guys to really understand that. There is no other choice but to let go and trying to figure out a set of rules. So you can use mine because I've been processing mine, but like I said, my set of rule is not a magical one, and some other guys out there have been putting other sets of rules and stuff like that. So all I could tell is that just if you want to figure out your own set of rules, then just do it. If you want to use someone else's and make it personal afterwards, I think that's the best way to do things. Like you start with something that has been pre-filtered by someone else, and then you make it personal. So that's the way I try to teach you trading in any way. That comes from both learning at ranges. All those things are following the same patterns. The way I teach you trading is the way I want you guys to process ranges with a logic. All right, you need to use logic because that's the easiest way for you to have a clear mindset and try to flush out all the negative emotions and impactful emotions you could have in trading. It's not to have cold-blooded decisions, because we certainly can't do that. We're human beings and we feel stuff whether you like it or not. You're never going to be a robot. And anyway, market just can't be about robots, because robots are programmed by humans, so they have human biases printed in them. And that's just how it is. Markets will always be about human behaviors and how they relate to prices and stuff like that. So these will always be chaotic, and humans are evolving, so you'll never figure it out. So just drop it. I know it's hard, but just let it go. All right? And just to give you a glimpse of how true this could likely be, just like I said, if guys that were seeing those problems with the electrons, for example, some people have been working around this problem for a decade, and they just drove themselves crazy. Those who actually found a solution to this are the ones who actually dropped the problem and say, all right, fuck that. We're just going to stop trying to understand. We're just going to try assessing the structure, trying to see what we can understand out of chaos. And I would tend to finish with that video to just try to explain that in the most beautiful way. Alright, so this is what we call a bifurcation diagram, and this is the pure expression of chaos and structure in chaos. So this is one of the many examples I could use, but I think this one is just the most explanatory one and the most easiest one for people to understand what I'm talking about. So if we were just posing on this thing, all we could say is that this is the pure you need to really understand what a bifurcation diagram is. So I sincerely invite you, if you're liking what you're seeing in here, want to know more about it, there are plenty of things to dig into this to really understand what that is. So I invite you to have a look at this thing. This is interesting, obviously, but I'm just going to try summarizing the core informations for you in here. So this is what we call a fractal structure in here, in which we see resonances. So that's the expression of what I'm trying to assess for you here. As you can see, we have resonances. This is chaotic distribution, but we can see that in this chaotic distribution, these are dots, actually. If you were zooming in, these are just dots that have been zoomed out in a significant manner. So you can see areas, and you can see how those random dots tend to have a structure. We can see those clear dark dots in here in which you don't know, but you know that there are more dots into this area, and you can see that those dots are following a pattern. So which means you don't know where the dots can be into the nearby area, but you'll know that there are slightly more chances for dots to show out there. That doesn't mean that they will show right in here, but if you take 1,000 dots into the nearby area, you'll have more dots into this resonant area. That's simple as that. So that's one way of seeing things, by converging vision, in which you say everything that happens in that nearby area is likelier to be into this spot, concentrated into this spot, rather than being dispersed elsewhere. And we have the opposite way of thinking, in which we can say that out of this pure chaotic structure, what do you see? Out of chaos, sometimes beautiful, standard, stable structures tend to emerge. So there are some resonances and cool downs into the way chaotic structure will happen. So in here it's a mathematical function, which means that this is the purest and most beautiful way of showing these regularities, even at some point which in here can be predictable, which means there is a ratio coming out of this because the structures tends to repeat and therefore be predictable. But the thing is that this is an equation. This is something stable that predicts and produces unstable results. But there is stability with the instability with these structures because they are constant in any way. This is an equation. Markets are always evolving, so you'll never get something like that. But you get the process. This is the illustration of what I just told you about. There are some structures in chaos. And what's beautiful in here is, I'm just going to apply the button and let it go. You'll understand that everything is going on at different scales, just like I try to teach you the multi-layered scales of multiple time frames, for example. I think this chart all by itself is the purest representation of my work into trading. So it's real complex, and I could talk about this thing for hours, but this is exactly what I would like you guys to, this is exactly what I would tend to say is the closest thing to the way I see the markets. It's unpredictable, it's beautiful, it's resonating, and those resonances are unpredictable because in real markets, this is definitely not like that, but there are some constants. And by understanding and figuring out that what you need to focus on is those constants instead of trying to figure out the entire stuff, it's how you should be seeing trading. Stop wasting your time into trying to understand, just trying to understand what can be understood, which is trying to figure out those resonances, no more, no less, and don't try to go any further than that. But in that diagram, if I just gave you an example, what they figured out in here is that there are some constants. This is exactly what brings the structure to this thing. There are a little bit of constants. So in here they're mathematical, which means they can be demonstrated and they're beautiful. There are two constants out of this thing, which means even if this thing is chaotic, there are some things that always remain the same. This is what we don't have in market, because those things in markets are not numbers, they're not predictable. But in here, for example, the structure is what we call the Feigenbaum ratio, which is basically what we can figure out is that two bifurcations, like in here, the bifurcation diagram is splitting in two areas, all right? After splitting into two more areas, all right, what we can figure out is that the Feigenbaum ratio is basically, if you take that and that, right, damn it, all right, the time scale between two bifurcations, you'll have always the same ratio, always, right? Which means, let me just go do it better, right? So here is what it is, all right? If you take that bifurcation diagram in here and then in here, every ratio before the next bifurcation is always 4.6 or something getting closer to 4.6 as the things moves on. So the next bifurcation is always 4.6 times shorter than the previous one. There's always this ratio. So it's a constant, which means it's predictable. You can know when the next bifurcation will occur. Even though the structure will be freakingly chaotic, you know when the split will happen. That's very interesting. And obviously this is linked to chaos theory, which means some part of these glimpses can be predictable, but then it gets unpredictable as we go further. But what we can see is that out of pure chaos, at some point, structures emerge in anyway, and those structures are firstly stable before they destabilize. So there are some ways in which this thing can stabilize before it destabilizes again. But that's the beauty of it. That's really the beauty of it. And the structure you have in here, you got the same in here, but at a different amplitude, different magnitude. Same thing goes in here. These are fractals behaviors, all right? So we barely have the same things into trading. They're definitely not the same, as they're way more complex. But these structures are here as well. If we were to modelize our ranging structure, the resonance area we just talked about, like the two sets of waves and stuff like that, will be the rules, the equivalent of our Feigenbaum ratio in here, because there is another ratio. If you would take that bifurcation in here, right, like if you take this, horizontally speaking, right, and take this one, all right, out of this one, all right, each bifurcation is 2.5 the other one. There is a ratio in here. So there are two constants into this thing, which gives us predictability out of unpredictability. But these things works into larger scales, and as we tend to go chaotic, they lose ground. They're still there, but that doesn't mean they're predictable, because there are so many dots in here that you just can't understand anything. So that's the beauty of it. Those rules tend to behave when the structure is somewhat stable until it destabilizes and restabilizes again. So this is how you go, and this is how you must see trading as well. You don't give a shit about when the dots are dark gray in here. All you care about is where are those real dark gray dots in which you can do something. So that can be, for example, our 76% fib or whatever. Or let's call it that this is a momentum signal, right? This is a resonance signal. And this would be, for example, the 61% Fibonacci, and that would be the 76. These are cool down areas in which we limit the possibilities. There are not crazy amounts of dots in here, and it starts to be somewhat predictable. That doesn't mean it will happen, all right? Like if you take it vertically speaking, at that point you've got three options, all right? Three option doesn't mean you're going to find the right one. It simply says three option is far better than the millions you'll have in here, because there are millions of dots into these areas. So in here is millions of possibilities, in here is just three. That's far better, don't you think? That's exactly what risk management is about. I always tell you to figure it out this way. This is not about figuring out what's going to happen. It's about limiting the possibilities. The lowest amount of possibilities, the better the risk management will be. You're never figuring out the outcome, but still, anyway, you just limited the risk. It's far better to speculate into this area than this one, because if you throw the dices a million times, you'll obviously be right at some point, because you've got three options. Throw the dices in here and just bet on one number. What the fuck would it be? And that's not what we do in trading. We're not betting on a number. We're betting on an area. We're saying we're figuring out the dots to be into this area. All right? So what does that mean? That means that when we are in those safer areas, we can be a little bit more aggressive. We can shrink the area of those boxes. As if we want to have a successful bet into randomness in here, we would like to put large boxes. All right? And in trading, we've got risk-reward ratios, which means we always want to get more than what we risk. Reason why, this is those areas that are really important. Those ones, they're pretty random. So you can gamble in here. It's more like a 50-50 return. To get a positive outcome, you're going to have to risk a lot. And that's not what I'm trying to teach you. Anyway, I hope today has been gathering your interest in any way. We're going to stop this series about ranges and chaotic structure. Next time, we're going to go for ranges. We're going to go For trending structure, which is unstable and predictable anyway, is chaotic structure everywhere in trading, but the trending structures are a little bit more easier to understand because a trend is a trend, which means there are human behaviors in there, but we're going to talk about that. I hope you learned quite some significant things with those series about ranges. I hope that this last one has been broadening your vision into some different topics aside from trading, and hopefully created connections into your brain so you can memorize those informations more easily. Anyway, bye guys, and see you either tomorrow for our usual live session into Discord, in which you can get and ask me, can come and ask me some questions. If you want to do it, that's pretty simple. Either you get yourself into the live session. We're going to start approximately 2 p.m. in my local time frame, which is EST +1, if my memory is right, GMT -1, sorry, and you will be able to, if you can't make it live, you're going to just be able to ask your question into indicator question, strategy question, or random question. Make sure that you put an @PhilRx mention before the message so I can be sure to see it, and I will be able to answer your question live. It will be recorded session, so I forgot to do it last time, so sorry about it, but this time I will do. So there will be a replay available here on YouTube, so if you want an answer to a question, ask your question, I'll answer it live, and you'll be able to find your answers into this podcast after the replay has been uploaded. And if you want to be live, then you can be live and ask me real-time questions about whatever it is that you might not really understand into the strategy, every shadowed out gray areas of stuff like that, or if you have specific questions, if you want me to review a trade, or if you have any other questions, that's the best time for you to ask me in real time. It's a question answer, so you ask the question, I answer in real time, so that's really great, way better than sending an email and having to wait for a couple of days to get the answer. Anyway, bye guys, eventually see you tomorrow. Those who can't or don't want, no problem, we'll see each other again next week as we'll start another series about trends.